Hello and welcome to United Asset Strategy's third quarter market update. My name is Thomas Healy. I'm our Chief Portfolio Strategist, and with me today, as always, is Matt DeLorenzo, our Chief Investment Officer, along with Jiorden Sanchez, one of our Senior Portfolio Managers. Just like the last two quarters, the third quarter ended with both stocks and bonds down. To happen one quarter it happens, but for 3 quarters in a row is highly unusual. And the reason is they have a common enemy, which is inflation. So Matt's going to discuss that, but I thought I'd draw sort of a real-world parallel to help understand this whole dynamic. And when you think about something like hyperthyroidism, meaning you have an overactive thyroid, what the doctor does to deal with that, because it's a very dangerous condition, is to provide medicine that actually destroys part of the thyroid to bring it down to normal levels. But two things that are oftentimes happening is, one, it takes between 6 weeks and many months to determine if the right level was administered. And the second thing is oftentimes they overshoot and lead to an underactive thyroid. And so the parallel there is what's going on here, which is the disease is inflation. And the Federal Reserve is trying to push inflation down with interest rates by actually destroying demand, which will then reduce the economy, bring inflation down to normal levels. Unfortunately, it takes time and us analyzing the data to determine if the Fed is actually doing it at the right level. And then sometimes it actually pushes it into a recessionary type economy. So these are what we're really watching right now. And so to give you sort of the details, I'm going to turn it over to Matt to discuss inflation.
Sure. Yeah, so as Tom mentioned, the Fed has been doing a lot. They've been winding down the balance sheet. They've been hiking interest rates. They've been projecting further interest rate hikes all the way into next year to really adjust the demand side of the equation. So earlier this morning, we actually got the most recent CPI report. So on the headline, it was up 8.2% year over year, which is obviously disappointing that a lot of the Fed's efforts are not showing up in that particular report just yet. But as opposed to looking directly at one report for a full read on the situation, what we've really been doing is looking to see if some of the drivers of the inflation are really coming down. And in my opinion, there's a lot of positive signs. One of them is that the Fed's actions have been directly increasing the price of the dollar, so that takes a lot of pressure off import prices. We've seen commodity prices come down, so there's been some relief on the energy front as well. And other things that have been causing some of this inflation, one of them has been pressure on the supply chain. We've had delayed shipments and increased costs to bring goods overseas, back from overseas. So we've seen prices. One example is the cost of a 40-foot container going from Shanghai to LA was over $12,000 a year ago, and now it's back down to $3,000. So a lot of this has begun to improve, even though it hasn't showed up particularly in the CPI report yet. So there's a lot of encouraging things, and it kind of shows that a lot of what the Fed's doing is having an impact already.
Okay, with that as a backdrop and given the environment, what are our bond managers doing to navigate through this fixed income environment?
Sure. So the most obvious thing that we started to do this year was take any cash that we had reserved aside in anticipation of the turn of the Fed, and we began to invest that at higher interest rates. So really across the board, interest rates on all different bond types were higher. You're getting a lot more yield now compared to last year. So that was really the first step. And as this accelerated, as the Fed kept going further and further, we moved into a point where there was an inverted yield curve. We started extending duration a little bit further because generally the inverted curve is a precursor to economic slowdown in an environment where you'd be rewarded more often than not for being in longer term bonds. So that was really the second step. And then aside from that, it's really what we're always doing, which is looking at relative values between bonds and weighing that against the economic backdrop. So most recently, given what the Fed's doing, given the anticipated slowdown, pressure on the equity markets, we took a recent bounce as an opportunity to lighten up on some credit risk. So we sold some bank loans, preferred stocks, and reinvested those into higher credit quality securities. So playing those relative values over a longer time period generally has served us well and helped us generate some good returns. So we're still focused on that.
Okay. All right, great. Thanks, Matt. So while it's pretty obvious that inflation and interest rates are detrimental to bond returns and create more volatility, what are we seeing on the equity side with respect to those different inputs?
Sure. There's definitely an impact on the equity side too. So the Fed's decision to increase interest rates do a couple of things. One, they make fixed income yields a bit more competitive relative to equity returns. But two, it also has implications for the macro outlook and growth as it relates to potentially dampening that a little bit. Those two things reduce the amount an investor is willing to pay for $1 of earnings. So in other words, a PE multiple. So what we've seen so far this year is the S&P 500 is down about 24%. So it's been a tough year. But it's important to note that earnings have remained resilient. They're up about 6% so far year to date. And it's really been the multiple contraction, in other words, the PE multiple, that's driven the downside. And that's down about 30% or so. You're also seeing the pressure in the areas you would expect them to be. So for example, high multiple stocks like growth stocks are down, and underperforming value stocks by about 15 percentage points. And cyclical stocks, those most exposed to potentially slowing macroeconomy, are down more than defensive stocks, also by about 15 percentage points. So that's how you're kind of seeing these interest rates kind of flow through into the stock market.
Okay. And so again, in that backdrop, with that environment, what are our equity managers doing to navigate through this volatility?
Sure. So it's always important, especially during market downturns like this, to try our best to manage near-term risk, but also to kind of keep our eye on the long term and look for investment opportunities that could arise as stocks get cheaper. And so we're doing those things. As it relates to the former, the risk management component, we have a number of equity strategies, and they're all using some mix of the following. Higher cash levels, some forms of hedges, like for example an inverse ETF. Some of our strategies have very proactive stop loss orders built into them. Across our strategies, we're generally also trying to tilt away from areas of pressure. So in other words, having a little less growth exposure than we would normally have in the strategy, having a little less cyclical exposure than we would normally have in the strategy. And then maybe from a bottoms-up perspective, cheaper valuations do allow us to sort of improve the quality of the portfolios we own, which is good in a time like this, because if you're able to kind of focus a bit more on companies with stable cash flows or more conservative balance sheets, they're probably a bit more able to sort of withstand a tougher potential macro scenario. Now that's one side of the coin. The other side of the coin is market pullbacks often generate long-term opportunities, and obviously for our clients the goal is always long-term financial goals, and that's what we're investing for. So it's important to kind of use these opportunities to be a bit opportunistic as well. And from a top-down perspective, what I would say is, given the decline in the stock market, the S&P 500 is trading at about a 14 to 15 times multiple. That's significantly down from 22 times earlier this year, and it's actually below what we've paid on average over the last 2 decades, about 17 times. So we could potentially buy things at more attractive levels at these points in time. And then another quick data point is, I alluded earlier that the markets are down this year, but in past scenarios where we were down more than 20%, you've statistically seen more attractive go-forward returns. So for example, on average, 1 year out, the markets are up about a little over 20%. 3 years out, they're up a little over 40%. And 5 years out, they're up a little over 70%. So it does kind of help kind of put it all tied in a bow in terms of being able to invest in these lower multiples in the long run generally should drive healthier returns.
Great. All right, thanks. So it sounds like one commonality across both our asset class teams is upgrading the portfolios, but also looking for opportunities. And I think these declines are presenting such opportunities. The other thing that we're also looking at, obviously we have an election in a few weeks. We can get into all kinds of depth on that, perhaps on another call, but what I would think suffice to say is, historically, at least 7 of the last 8 elections, the party in power has lost at least one of the 2 chambers of Congress in the midterm election. So, and given the fact that we're at a 50-50 Senate and a 5-seat majority in the House for the Democrats, and given the way things are trending, it's likely that that's going to happen again. So, and the positive on that is, historically, coming through a midterm election, markets actually rally because a mixed government provides more policy certainty. And I think that's something that we also cognizant of as we're making investment decisions. So just close with a couple of housekeeping items. One is you might have got an email saying that October is shredding month. So you still have a few weeks if you want to come into our Garden City office and shred documents. That'll be available to you. And another reminder is now we're in the fourth quarter, so a lot of things get done at year end, like RMDs, required minimum distributions, charitable contributions, things of that nature. And so what we would ask is as soon as you're able to start that process, our team is ready and willing to get moving on that. And so working with our custodians to make sure we get everything done expeditiously. So again, I want to thank you for your time and attention, and we look forward to catching up again next quarter.